Welcome back to the Stock Market Option Trading Podcast. I'm your host, Eric O'Rourke, and this is episode 151 of the show. Keep in mind that we just started doing some of these on video, including this one over on YouTube. So if you're listening on audio and you want to see the charts and the indicators that we're going to be talking about today, feel free to head over there. I'll put a link in the description. And if you're watching on YouTube, be sure to check out the audio version because there's almost 150 episodes on audio that are not here on YouTube. Now, before we get into this week's market update and economic events, I want to talk a little bit about, this is very relevant to right now. I want to talk a little bit about indicators and how outliers in price can distort indicators. And once volatile action comes out of the calculation of the indicator, you can see kind of a shift. This is a perfect example this week of what we're seeing. The indicator we're going to use as an example, now this is true for all indicators. We're going to look at the weekly forecast for alpha crunching, which looks at the most recent 4 weeks of data. Now, on the chart here, I have a box on the daily chart, and we can see the most recent 4 weeks of data. But if you notice that the week or so before, we had very, very choppy, big candles, lots of volatile price action, and we had a pretty significant market low. That market low was Monday, April 7th. And then 2 days later, on Wednesday, April 9th, we had that huge up day. I think the market was up, I want to say 9 or 10%. I think that's when there was some relief, tariff relief. It was, the headlines were around there, and the market just took off. Well, with any indicator, basically all indicators look at recent price action, and those big numbers are going to go into the calculation for that indicator, and you can get some skew. Even if we're looking at just short-term indicators like moving averages here, we can see a huge spike up after that big candle. So what we're looking at now is the most recent 4 weeks that the forecast indicator looks at. Those big candles have dropped out of the formula. So if you're looking at, let's say, a 20-day moving average, then the data that's 21 days obviously is not going to be in that calculation. And one interesting thing with the forecast is that this week the forecast still looks pretty bullish, although we continue to talk about sort of a pullback in the beginning of the week and end of week strength. That's kind of been the week over week pattern the last few weeks. But if we overlay last week's forecast, we can see that this week's is much lower. The ending point value, these are based on SPX points. Last week was 200 points, was sort of the ending value. And then this week, it's only, 80, let's call it 90 points. So if you're looking at this data and you'd say, oh, well, maybe the uptrend's in trouble, there's some weakness happening. But what I want to notice here, or want to point out at least, is that with last week's forecast, you had a couple big price spikes. These price spikes coincide with those two days I mentioned, that Monday and the Tuesday gap up, and that huge Wednesday morning or that Wednesday rally on the back of those positive tariff headlines last month. So these two sort of price spikes lifted the whole forecast up. So we still see that this as a bullish forecast. But now that this data is out of the calculation for the indicators, and it will be for many other things, you're going to see volatility be coming down. And this can also be reflected in the VIX. If we take a look at the VIX at that time was, it peaked around 60, and it's kind of been coming down ever since. But the inverse of this is basically the VIX dropping super hard on the news of those positive tariff kind of trade war related headlines last month. So now that the VIX is coming down and price is a little bit less volatile, we are seeing an uptrend in stocks, and that has been in place for, I'm going to call it, a month. So even though I'm looking at the forecast here and I see that the net cumulative value of the points for the end of the week is about 90 points, I'm not going to be overly bearish here and say, okay, well, what do I need to do to short? There's weakening in the market. And really, the weakening that we're seeing in the indicator isn't weakness in the market as of yet. It's just simply data falling out of the calculation, which makes the indicator look a little bit weaker. So sometimes there can be lag when you have big price outliers, and there can be some lag in your indicators. And that is true for the forecast indicator as well. So with that said, We are seeing a still, relatively bullish forecast for the week. We're looking at the highs of the week in points tend to be the end of the week, but we do see some early week weakness and really some choppiness around, let's call it Monday to Wednesday. If we go on 2 weeks before, we see a similar pattern of chop, and then we start to make more of an end of move week. In bullish conditions like we have right now, the end of week move tends to be strong because investors are confident of holding stocks and things over the weekend. If we get some end of week weakness, that may be a sign that maybe there's some caution for whatever reason. Now, these days with all the tariff headlines and everything, we can get volatile moves and surprise action, really, and that's really what we're seeing today. Let's zoom in on the S&P 500 daily chart. I have the first indicator here is the 200-day moving average. It is let's call it 5750, and the market has gapped up. We were up about 3%. We're still up 2.5% here on Monday the 12th. We're about an hour, 2 hours into the open, and the market has gapped back above the 200-day moving average, and it looks like 5800 might be a decent support zone, maybe even 5750. If I throw on the spot gamma major option levels, and we have a lot of them. They're all over the place. However, the concentration of them is still above 5,700, which again, we're trading just around 5,800 right now. Now, to start the week, the call wall was at 5,800. However, given the fact that we're gapping up so hard today on the back of news that China and the U.S. are resetting the tariff negotiations and maybe the tariffs themselves, I don't know exactly what that means, but it's a positive note. And anybody who was shorting the market is getting obliterated today because we are up again 2.6%, about 150 SPX points, and we are back above that 200-day moving average. Again, the vol trigger is something that I kind of keep an eye on. Zero gamma vol trigger is in the mid 5600s. However, I do think 57 is probably going to hold. And once more data comes in with the options positioning, because this positioning, I'm sure, is changing as we speak with the news, these levels may look a little bit different. If you want them to see these updated every day, you can check out Spot Gamma for that type of information. So with SPX trading here at 5,800, the other thing I want to look at is the major option levels that are above, so we can see, like, where is resistance. I know my initial reaction to everything is to do the opposite. I have a little bit more of a contrarian attitude towards things. So when the market's up 150 points, I immediately start looking to sell calls, right, or call spreads. At this point, because it's a news-related headline, I've learned that it can go higher and it can go lower. So I don't have any real setups for shorts, thinking about this, but I do think that 5,900 looks to be probably the next major level, with hopefully we hold support around 5,800 and maybe we dip to 5,750. But right now, the concentration, and you can see it here in these lines, positive and negative gamma, a lot of it is in the range of 5,750 all the way up to 5,900. So that's kind of the short-term range that I'm looking at. We'll see how the headlines play out over the next couple of days. And we do have a few economic events that could sway the market a little bit. On Monday, May 12th, Trump is speaking. I think that was about the China-U.S. trade talks. Tomorrow, on Tuesday the 13th, we have core CPI. So we have inflation on Tuesday, not much on Wednesday, and then core PPI on Thursday, but Powell also speaking before the bell on Thursday. So the way I'm kind of factoring this in is thinking about, okay, what was the biggest driver for this pullback? The biggest driver of the pullback was tariffs. And now that those are, I'm not going to say they're over, but there's negotiations happening. There are a couple deals. I don't think it's as great as anyone thought it was going to be, or that they were touted to be. But the fact that there are negotiations and that tariffs aren't going to shut down the global economy, there will be some shifts. There will be some winners and losers, but the whole world is not going to shut down. you're still going to be able to get toilet paper, and the price of eggs are down. So it's not the end of the world like it was, a month ago. But I do think that we might be a little bit limited because there's still not a lot of certainty about where and when the tariffs are going to land. So again, I think short-term resistance is probably in the 5,900 area. If we were to rally up there in the next couple of days, I would consider initiating some short call spread positions, maybe at 6,000. Let's call it 2 weeks out. Until then, if we look at the short-term uptrend, and that's what a lot of the stuff that I trade. If we go back to the alpha crunching trade ideas tab, this thing is really starting to fill up. And what the trade ideas tab does is it shows back-tested trade SPX trading strategies that are based on the triumph rates, And just to kind of get a glimpse of that on the weekly triumph rate, if we scroll down to the grid here, we see that we have increasing numbers here. We went from 44% to 56% on Monday, Tuesday, Wednesday, Thursday is up as well. And what these numbers are telling us is that the market is closing higher week over week over the past couple of months. This is a little bit slower of a, I don't like to call it an indicator. It's more of a computation, but it's a little bit slower moving. So over, the past couple of months, Monday has closed higher 56% of the time, but last week it was 44 and the week before was 38. So these are mildly improving conditions, and it can be seen obviously in the chart itself. So what I'm going to be focused on this week is looking at some of these trade ideas. Monday, today, we have a put credit spread set up for the end of the day. However, with core CPI and this large gap up, I may wait a day to initiate new longs to see if we get any kind of pullback to the 200-day. The good news is our WTR trades. We took profits in the one we opened Thursday. On Thursday, we opened a 7-day put credit spread. We sold for $2. We were able to buy it back today for, I think it was 85 cents, so a little bit better than 50%. And then on Friday, we initiated a 3-day to expiration put credit spread that hopefully will expire worthless. We initiated that towards the end of the day on Friday, and the market was down here around 56.60. I think that's where our strikes were. So with this huge gap up, and we're now trading at 5,800, I'm going to hope that the market holds these levels and doesn't fade hard at the end of the day. So we're continuing to take these trade ideas when the conditions are met, and more are starting to show up. We now have more put credit spread trades, and we'll continue to kind of manage our risk along the way. So that's what I got for this episode. Again, if you're watching on YouTube, check out the audio version over on Apple and Spotify. And if you're listening over there already, come check out the YouTube channel where you can comment. And that's it. Have a great week. I hope you enjoyed the episode, and we'll see you in the next one.